Good morning. It's Wednesday, March 18th. Here's what's on the agenda. President Trump ditches his appeal for help in the Middle East war. The oil shock hangs over Fed Day. And Nvidia fires up supply chains to send chips to China.
So oil prices are down this morning, down 1.7%. We'll give you the details in terms of pipeline flows from Iraq into Turkey. Brent crude at 101 as things stand. That is one of the catalysts for these markets. So is the focus on semiconductors and some listing changes over in Korea. The Kospi then rallying once again on fire, up 5%. European futures getting a lift from these catalysts today after gains of 0.7% yesterday, looking to add 1%. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Wednesday, the 18th of March. Let us take a moment to just stock take, think about where we are in terms of the relationship between the war in Iran, what we're seeing on oil prices and what we're seeing on markets, because we are still in that environment this morning where oil prices are down and that's risk on. And that's sort of in keeping with what we've seen over recent weeks. But worth asking questions about whether we're trying to break that link. But just taking stock of where we are in terms of escalation signs, escalation narrative. We've seen President Trump ditching calls for NATO's help. We've seen President Trump threatening to expand strikes on Kharg Island, that export hub, of course. We've seen Ali Laranjani being killed. All of that would suggest to an escalation of tensions. But there are, on the other side of things, signs that perhaps the pressure is being relieved a little bit, certainly in the oil markets, where we see exports from Iraq going via a pipeline via Turkey instead of the Straits of Hormuz. So the market trying to find its way through this. For the moment, we are still caught in this oil down, risk on dynamic, and that's what we see being painted for markets this morning.
Yeah, when it comes to the killing of Ali Laranjani, the security chief in Iran, some analysts saying that that could make Iran more desperate to disrupt oil flows. As you say, it's positive, the development when it comes to Iraq agreeing with Kurdistan to resume exports via Turkey. The only ships that seem to be getting through, and some are getting through, are hugging the coast of Iran to get through that Strait of Hormuz. So clearly they have an understanding with Tehran, and that comes back to what JP Morgan was saying yesterday. It's a new normal when it comes to who gets through the strait. The gas disruption also notable. Iran setting a massive natural gas field ablaze yesterday, and those disruptions to gas supply coming just a few weeks before the official start of Europe's stockpiling season. So European natural gas prices, HSBC says, will be 40% higher than previously projected, stay there through 2027, which takes us to the inflation theme.
Well, to the here and now, 400,000 barrels a day additional coming through from Kirkuk and from Kurdistan. That's happening today. That happened in the last few hours. That oil's getting back onto the market into Turkey. We are seeing those cargo ships now, some of them, again, getting through the Straits of Hormuz. That seems to be what the markets are latching onto. But I'll come back to your point, Anna, that this seems to be a market now in terms of how traders are thinking beyond the conflict. Maybe there's some fatigue here. Maybe they're looking ahead to the earnings season. Maybe they're getting a reminder that there's still demand when it comes to AI and semiconductors. This seems to be a market that, at least for now, is looking through the turbulence in the Middle East, maybe looking ahead to what happens with central banks as well today.
Yeah, and trying to. And yesterday, we just look no further than yesterday's stock performance versus what was happening with oil companies. In Europe yesterday, we saw stocks were higher and energy was part of that. Energy stocks were higher. Why is all of this happening? Why are we asking questions about whether the markets can look through this? Well, we've got this nice chart from John Author's story this morning that underscores that there are other drivers. To your point, Tom, it could be tech, it could be other things. There are other drivers behind resilience of stocks. Is it complacency? This chart is illustrating what earnings are doing. Now, earnings not being downgraded sounds like a good thing, but is it just that they have not been downgraded yet? And that is certainly something that we'll keep an eye on as we go through the earnings season.
One of our guests yesterday said that we're moving from the phase where we're driven in markets by headlines to a phase where we're driven by the policy response to the war. And indeed, we'll get the Fed response, its first response today, a hold expected. We've also got a nice chart on how front-end yields have risen on higher crude prices. And that's not just in the US, that's in Germany and the UK as well. We already saw that RBA rate hike in Australia. Kim Crawford telling us that that's not the canary in the coal mine for central banks. As I say, the Fed expected to hold today for a second straight meeting, but it is going to be interesting to hear how they unpack this debate between the inflation risks in the short term and the growth risks in the longer term when they have a dual mandate.
I like this quote from Diane Swank of KPMG, chief economist. Whenever I'm quoting from her, whenever you have the Fed's dual mandate becoming a dueling mandate, there should be debate. The focus then will be on how Jay Powell characterises those tensions between that dual mandate and that dueling mandate, of course, the labour market and the inflation question.
Yeah, and there's some technicalities in there, aren't there, about how the labour market mandate takes precedent if they are in tension, but it depends on the degree to which they are. So that will be, as you point out, a real area of focus. Meanwhile, bond markets have spent, well, the period since the Iran war first started, they've been pricing in higher inflation, they've been sending yields higher, and that's been the direction of travel. Just in the last week, and as a result, pricing out cuts from the Fed. Just in the last week, though, we've seen a bit of an about-face, just at the margin, pricing in one cut for 2026. So as if the market is prepared to think, well, maybe the market is buying into the idea that this is going to be a short war, or maybe the market is thinking, actually, this goes through an inflation concern to a growth concern, and the bond markets, therefore, would respond in a slightly different fashion.
OK, the focus on the central banks, as we think about inflation, there's still a question mark as to whether or not AI is inflationary or deflation. We've had some updates, of course, from Nvidia. This is really important. The H200, so these are the chips that they've designed specifically for the Chinese market, and Jensen Huang saying and making an announcement that they are now starting to produce those chips. They do have those licenses now, so they can start to ship those into the Chinese market. The reason it's important is they have not added revenue from China in recent quarters. Now it seems they will be able to do that. Reuters reporting that indeed some Chinese companies, multiple Chinese companies, have been given the green light by Chinese authorities as well. So it seems both the US and China opening the gates for these H200s, which is significant on the revenue front from Nvidia.
Yeah, I mean, that is because they've taken a really conservative approach, haven't they, saying we're going to assume nothing from China, and now we assume something, so something is better than nothing. Thinking about where AI takes us, really interesting, highly read story on the Bloomberg terminal, quoting the Oaktree CEO, Howard Marks, talking about people underestimating what AI will be able to do, not necessarily for the good, but certainly that's an interesting read. Kathy Wood yesterday on The Pulse telling me that even the, how did she put it, even the East Coast cynics are being convinced by the potential of AI. So it's not just the sort of West Coast vibe that is pitching this stuff. It is getting buy-in, and people are being convinced the productivity gains, she says, are real already.
We've often talked about the risks to private credit, and I like the line from Howard Marks where he's saying you'd be better off buying shares in AI companies than lending to AI companies money. If you're taking the risk, you should get paid for it, Howard Marks says.
I'll just touch on what's happening in terms of pricing, because really interesting developments over in China as well. You've got Baidu and Alibaba raising prices for their AI products. At the same time, as South Korea's chip makers, when it comes to memory chips, are suggesting that still we get 4 or 5 years of tighter supply. And Samsung, around this point, looking to change contracts, not just quarterly contracts for its clients and customers, but potentially multi-year as they try and address those supply shortages to give them that clarity as they try to build out production. SK Hynix, Samsung, of course, gaining in the session today.
And we will get Micron numbers a little bit later on, talking about the pricing of things and chips. Let us tell you what is coming up in the programme then, guest conversations that we will be leaning into. We'll be joined by David Rees, Schroders Global Economics Head. So ahead of the Fed meeting, ahead of, well, reflecting shifting expectations around how the Iran war plays into inflation and growth, we will talk to him. Andre Kellen as well be with us, Goldman Sachs Investment Banking EMEA co-head. What are we seeing in M&A? Such expectations coming into this year on that front. But what has the war in Iran done to the markets around M&A and IPOs? So Sophie Wynn will be with us, BNP Paribas Asset Management Portfolio Manager and Strategist. Those robust earnings, that robust earnings story that we were talking about from the John Authors piece, that will be reflected in that conversation. And we'll also talk to Vincent Rouget, the Unibail Rodamco Westfield CEO. How are consumers facing? Are they switching off from all the negative headlines, frankly, and just spending regardless? We'll get into that narrative.
Let's look at what else we're watching throughout the day. At 12:30 p.m. London time, we get US PPI numbers expected to have risen at both the core and headline levels in February. Then we also have the Bank of Canada rate decision. That's at 1:45 p.m. London time. At 5 p.m. we have the Disney AGM, Josh D'Amaro becoming CEO. And at 6 p.m, of course, we have the Fed decision, followed by the press conference. And then finally, 9 p.m, those Micron earnings that we mentioned.
Here's what else to be thinking about this morning then. Berlin's Brandenburg Airport is set for a complete shutdown today. A planned labour strike threatens to cancel flights across the board and disrupt plans for more than 50,000 travellers. No regular passenger services will operate after the union Verdi called on airport employees to stage a warning strike as it seeks higher wages. The next round of negotiations is scheduled for March 25th. UniLever is said to be considering a separation of most or all of its food assets as it looks for ways to streamline its portfolio. Sources have told Bloomberg the transaction would probably value the company's food business at tens of billions of dollars. We're told the company has not made any final decisions. And BHP has appointed Brandon Craig as its new CEO to seek growth in copper and potash while managing a slowdown in iron ore. Craig replaces Mike Henry and will take on the role from July the 1st. This comes as the company faces plateauing Chinese demand for iron ore, which accounts for almost half of its earnings.
The pivot toward electrification, key to this sector, of course, BHP leaning into copper. That's been one of the dominant themes we've been talking about in the mining sector for many years. And M&A, such a theme, which, of course, takes us to a conversation we'll be having later on this hour. The mining sector certainly at the forefront of some of that.
The new CEO has been there for about 2 decades. He's relatively young for a CEO.
Apparently,
two and a half, there we go. He's overseen the iron ore business, and then he's overseen the Americas business, which is copper. So the kind of history and then the future of this business as they shift to copper.
And that continuity seems to be appealing to traders. We've got shares already up in Sydney, so we'll watch where it goes at the European Open. Yeah, we'll watch the London listing. Coming up on the programme, Europe says no. Washington's allies on the continent reject pleas to join efforts to secure the Straits of Hormuz. The Greek Prime Minister, Kyriakos Mitsotakis, tells Bloomberg Europe must not be drawn into the Iran war militarily. We will bring you some of that conversation later in the show. But up next, we'll be joined by Deborah Cunningham, CIO of Global Liquidity Markets at Federated Hermes. Great conversation ahead of the Fed. If you have any questions for our guests, please do get involved in these conversations. IB plus BBTV Go. It's sunny in London this morning. It was sunny yesterday, 2 days in a row. That's got to be pretty special. 11 minutes past 7 here in London. This is Bloomberg.
So I think NATO's making a very foolish mistake. And I've long said that, I wonder whether or not NATO would ever be there for us. So this was a great test because we don't need them, but they should have been there. The other thing is, and I think, very important, we didn't have to be there for Ukraine.
President Donald Trump calling out NATO. Of course, NATO was there in 2001, but back in the here and now, the US president appears to have given up on his efforts to recruit allies to help secure the Strait of Hormuz as the Iran war shows no sign of slowing down. Late last night, Tehran confirmed the death of Iran's security chief after an attack claimed by Israel. Let's bring in Jumana Basetchi, our anchor, of course, in the Middle East and currently in Dubai. Jumana, good morning to you. So little sign that European and Asian nations are willing to join the fray. Where does that leave President Trump and activity in the region?
Yeah, absolutely, Anna. I would go one step further to say that Germany, France, Greece, Norway, Canada, they've all categorically ruled out the possibility of joining in on this mission, on this maritime mission to help reopen up the Strait of Hormuz. And of course, as is customary, President Trump reserved his sharpest criticism to NATO allies, calling it a foolish mistake, but that anyway, he didn't need them. He also put up a post on Truth Social criticizing some Asian nations as well, the likes of Japan, Australia, and South Korea, saying that he doesn't need their help either to assist with the effort. So I will say, though, overnight, there has been one interesting development from the region. A senior diplomatic advisor to the UAE president, this is Dr. Gargash, in an interview yesterday, he was asked whether the UAE would assist with efforts, and he didn't rule out the possibilities. So perhaps there is maybe momentum building within the Gulf region to help assist the U.S., but this is just one individual, I should say, emphasize. The takeaway here is that Iran effectively are still controlling who is passing through the Strait of Hormuz. About 12 vessels have managed to pass through in the last day, but they're all Iranian linked, and they were vessels that were headed towards either China, India, or other quote-unquote friendly nations. But since the inception of the war, about 20 vessels have been targeted and subject to the extreme security risks that trying to cross through the strait actually presents, which means that there's very little still passing through, and ultimately it is still Iran policing whether vessels can manage to make it through. And this is one of the reasons why, and you speak to energy experts in the region, you're going to continue to see this upward sustained pressure on the price of oil and on energy markets, because as long as there's disruption through the Strait of Hormuz, it's very difficult to get these energy products out to the world. At the same time, one other major development I just need to talk to you through as well, the confirmed killing of Ali Larijani, key security official in Iran. If anyone thought that this was going to lead to an off-ramp, mistaken. IRGC have already said that they plan to retaliate, and we are seeing a volley of ongoing attacks directed once again at the Gulf states and Israel overnight.
Jumana, thank you very much indeed with that update. Live from Dubai, of course, Jumana Pasechi, our Horizons Middle East anchor and correspondent out of the region, of course. And as the war in Iran continues to rattle energy markets, as Jumana was saying, shocks are reverberating across stocks and bonds amid concern that surging oil prices will stoke inflation. Today, of course, is a slightly different picture, but broadly that is what we've been seeing. How policymakers respond to that, then, is now top of mind for investors, with the Federal Reserve set to deliver its interest rate decision later today. Let's bring in, at this point, Deborah Cunningham, CIO of Global Liquidity Markets at Federated Hermes. Good morning. Thank you for joining us. Given what's happening in the Middle East, where do you think the emphasis lies then for the Fed? How do you think they land? Do they land on an emphasis around the softness that we're starting to see in the labour market of the US, or on concerns about energy and inflation?
I think you have both of those coming to the top of the discussion today. And what we see from a press conference standpoint post the meeting, it certainly seems like the focus had been on what employment was doing and how growth had slowed. With inflation coming a little bit further down below 3%, that seemed to be the appropriate stance to take. But now with the conflict in Iran and what we're seeing from an energy price standpoint, how that's flowing through from an inflationary standpoint to other goods and services, I think the dual mandate at this point has to be emphasized on both sides of the equation, with the here and now from inflation really being the top concern that we hear out of Chair Powell this afternoon.
Markets are pricing in one cut by the end of this year right now. It's whipsawed, of course, in the last couple of weeks.
It has.
Does that seem fair to you? And if they cut less in 2026, does that mean potentially further cuts and deeper cuts in 2027?
So we as an investment team came into 2026 expecting one cut, but with the exception that if we were incorrect in that outlook, that it would be two cuts. Now our expectation, we've stayed at one cut, but the expectation is going the other direction if we are incorrect, making it more like zero, not going into the territory two. However, that being said, depending upon where we end up from an inflationary standpoint, what we do from an employment and a GDP standpoint, further cuts in 2027 are likely the case. But our expectation would be still terminal rate north of 3%. So we're not back in like the 0.12 type of percentage rates, which I think is a sign of a healthier world economic situation across the board, and certainly a lot better from an endpoint for those that are in the cash markets.
Yeah, so Deborah, you spent a lot of your time focused on money markets, and so that expectation around the Fed takes us to how this filters through to the rest of the yield environment, I suppose. How competitive do you see money market funds being in that context? Because if we are in a slightly higher for longer, this is medium-term view, higher for longer environment as you describe, maybe that's good for money markets, but maybe that's good for other yields as well. So where does that leave money market funds?
I think it does. We've had cash flow in a very positive way since 2022, I think was when positive cash flow started. In the U.S., the industry is at about $8.3 trillion, just in Irish domiciled funds in the offshore market, over $1 trillion. So cash flow in 2026 has continued to pour into the industry. So I think with north of 3% and potentially touching 4% type rates, I mean, we've been buying those rates over the course of the last 2 weeks within the portfolio. Now, that doesn't mean those are going to play through to the overall portfolios yielding above 4%. But with those types of rates, I think people feel pretty comfortable that they're getting an adequate return for a very very conservative, low-risk product. Having said that, the next steps out the yield curve, micro-short products, ultra-short products, certainly are beginning to see those cash flows come through too, and I think those yields will stay at least north of 4% and potentially touching into 5%, depending upon where this goes.
That's interesting, because I was wondering, what is the link between risk aversion and what you're seeing in money market funds right now, given how the war is playing out in Iran?
Well, if you go back to when we were in 0 and 1% environments, the cash managers got very good and asset allocators got very good at bucketing cash. So only cash was left in money markets and true cash availability that had to be there. Next day's transactions, next month's transactions. But if you had cash pockets that were likely to be deployed maybe 6 months from now or 12 months from now, they went into longer term products. Right now, I think with yields north of 3 and touching close to 4, you don't really need those allocations at this point. But as sort of markets revert back to the norm and you get to a place where you think that more like 3.25% is the end result of this Fed cycle, then ultimately when you see micro shorts and ultra shorts start to gain acceptance and assets, it's a sign of sort of the markets continuing to try to seek yield that is at least north of 4%.
So would you say that the role of liquidity has fundamentally changed in portfolios because of this war?
It has. And I think what you've seen is sideline cash from other markets go into this market because they are not taking a huge hit in their return, and their safety and secureness is sort of upped from a standpoint of what's going on and trying to reduce the risk that they're taking. Now, that sideline cash isn't always going to stay in the liquidity markets. It's going to go somewhere else as soon as sort of the idea of the conflict ending starts to be thought of as a real possibility. And once that happens, I think you'll see some flows start to go out. We certainly have large institutional clients whose balances are much larger than they tend to be on a regular average basis.
And this is the sort of time of the year when investors usually want to pull money out of funds to pay their tax bill.
Absolutely. First quarter is one of the biggest outflows. If you look at each 4 quarters, first quarter is generally an outflow quarter. That won't be the case this year. Even though, yes, you've got corporate tax date that we just went through. You'll have individual tax date the middle of April. That will cause funds to flow out. But what's flowing in is still offsetting that.
Okay, great to see you, Debbie. Thank you so much
for
dropping in to see us while you're in London. Deborah Cunningham there, CIO of Global Liquidity Markets over at Federated Hermes.
Yeah, interesting then, that narrative about keeping cash on hand at a time of nervousness, time of geopolitical concern, inflation concern, that maybe that makes some sense for some investors.
But also the amount of cash that's on the sidelines then. So 8 trillion plus the 1 trillion in Ireland. Yeah. So that's $9 trillion potentially that could be put to play if equity markets start to seem a little bit more constructive. There's more conviction. There's potentially a lot of dry powder on the sidelines.
Yeah, and what's it going to take to release all of that in terms of the war? What's the headline that needs to cross to get us back to risk on? We shall discuss. But coming up on this programme, we'll get another view on the slate of central bank decisions this week from David Rees, Global Economics Head over at Schroders. That's next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes then this Wednesday morning until we get that cash trading for European equity markets. Let's have a look at the futures picture. And futures are pointing higher. The FTSE 100 maybe won't get the best of those gains. Euro Stoxx 50 futures up by around 0.9%. So some strength coming through. Energy stocks in London did well yesterday on the back of a higher oil price. Today we have a weaker oil price, down 1.5% on Brent. So might that make the difference between what we're seeing in the various geographies of Europe?
The bond market's looking relatively stable. Treasuries a bid this morning. JGB's a bid as well. European bonds largely unchanged. There's a bit of movement in terms of French sovereign debt in terms of what's happening with the OATs, the benchmark there, you're seeing yields down 2 basis points, so a bit of a money move into that benchmark. 353 is the yield there. German, so 289 right now, close to 290 on the benchmark. Bunds there, largely unchanged. And over in Italy, BTP is also seeing a little bit of a modest bid. Yields down 3 basis points at 362. Lizzie.
Well, as investors await today's Federal Reserve rate decision, a number of European central banks, along with the Bank of Japan, are preparing to unveil their own policy moves amid the heightened market volatility, driven, of course, by the Iran war. We're joined now by David Rees, Global Head of Economics over at Schroders. David, thanks for being with us. In your notes, you emphasise the second round effects of inflation. I'm thinking particularly about the euro area. Should the ECB be hiking sooner rather than later to avoid the mistakes of the past?
Yeah, it's a good question. So if you think about where we were coming into this year, we were quite optimistic on the growth story in Europe. We could see that fiscal stimulus was going to be coming through. We could see that probably the labour market was reaching a bottom and maybe an inflection point. And that set the scene for rate hikes, but in our forecast, not until the back half of next year. So obviously the markets brought all of that forward because of the energy shock. Gas prices have jumped significantly. Europe is pretty vulnerable and obviously very reliant on imports of LNG post the kind of Russia invasion of Ukraine. So there is a vulnerability there, and inflation is clearly going to be higher. The key will be whether activity holds up or not. Yeah,
well, we saw that pretty weak German ZEW data yesterday. Is stagflation now your base case?
It's certainly moving that way, yeah. So that was the key risk for us this year, coming into the year, and clearly things have moved in that direction. In a stagflationary environment, rate hikes don't make a whole lot of sense because the weaker growth would offset the price impulse. So really, I think all the focus is going to be on high-frequency activity data now to see if, for example, that confidence hit shown in the ZEW actually filters through into real activity data.
David, sticking with Europe, is it too, I mean, it's probably too soon to draw a conclusion about parallels with 2022, but so far, does the hit to inflation, the uptick inflation that we expect to get from higher energy prices, does it look to be a lot less, a lot lower than 2022? I was looking at this nice rule of thumb. You have $100 oil for a few months means G7 plus 1 percentage point headline inflation. I mean, that's 3 to 4% inflation then for lots of economies in the G7. That's not 10, 11% as we saw back in 2020.
Exactly right. So the magnitude of the shock is different. And frankly, the state of the global economy is different, right? Because if you think about the post-Russia-Ukraine invasion, we were coming out of COVID. You had this kind of quite strange economy that was very juiced up, reopening with very strong demand. And then you whacked it with a really big energy crisis that, frankly, cut energy off completely to Europe. So now the magnitude of the crisis is less. But that doesn't mean it could be completely ignored, right? It's still going to have its mark. And it comes at a time, again, when you've got a cyclical recovery dynamic coming through. So that's why I was saying the focus will be on activity to see if that holds up in the face of higher energy prices or not, because you do have stimulus.
So when you say the magnitude of the crisis is less, is that to the extent that we can know it so far?
Yes.
Or do we think that it just will be less because it's a different geography that plays differently into a different economy here in Europe?
Frankly, just purely a function of energy prices. They're not as high as they were at that point yet.
The Trump administration is signalling 4 to 6 weeks. They keep coming back to this time frame for the conflict, for the war with Iran. 4 to 6 weeks. Can the Fed look past the energy impulse from a 4 to 6 week conflict in the Middle East?
Yeah, I think so. I mean, if it's actually 4 to 6 weeks, you're talking about energy prices being elevated for a period of time. You get some hit on the upside to inflation, but probably by the time you get to the end of the summer, the inflation impulse starts to subside, and you could probably look through that and concentrate on things like core measures of inflation, activity in the labour market. What I would say on that is that if you look at the core measures of inflation and you look at core PCE, it's actually quite elevated at about 3%. CPI is lower, but that's obviously basically being driven by rent, which is a much smaller weight in core PCE. So it's not as though inflation has been completely defeated and the economy is quite strong. The numbers have been a bit shaky post the shutdown of the government and reopening, but growth's quite strong, and there's obviously twin monetary and fiscal stimulus still working its way through the system. So if it is a relatively brief energy shock, I think you would look through that but concentrate on the risk of second round effects. Probably your calculus on rates has shifted to being a bit less easing bias. But let's see, because I don't think...
You still see the Fed cutting this year? I mean, how does Jay Powell thread that needle today?
Well, I don't think Powell's in play, really, for changing rates anymore. I think with everything that's going on with the DOJ and pushing back against the government, unless things got really bad to the upside and he was thinking about rate hikes, I don't see him cutting rates. I think he's kind of backed away from that now. Our view has been that you get the new governor, presumably Walsh, coming in middle of the year with an easing bias and then tries to cut rates in the second half of the year. I don't think Powell's necessarily in play.
Yeah, how are you thinking, David, about the Fed's reaction function, given what you've described there is, of course, connected to data, but also a bit detached from data, because it's very much about the pressure that President Trump has been putting on those who set policy and whether that gets through and whether they then set policy in accordance with that view. What can we say about Walsh? I mean, also, we don't know if he's going to be confirmed at the moment. That looks a little opaque, doesn't it?
We don't know if or when, because in the background of all of this, we haven't really heard any updates on the DOJ and Powell, so who knows? It's another unknown. But let's see. I mean, our assumption has been that Walsh, I mean, he must have sort of interviewed for the job saying he would cut rates if he can. He's talked about pivoting the way that the Fed thinks about monetary policy to take a longer-term view, and within that he's talked about the deflationary impulses from AI. So there's a lot to unpack in all of that. To me, it makes a lot of sense that central banks stop looking at recent data to set monetary policy tomorrow and take a bit more of a medium-term view. That was the way that policy was meant to work, and things has all become a bit more focused on recent inflation data, which is understandable when you go through a shock and you're offside on it. But now we will see. I mean, if we're really going down this path of saying AI is going to be deflationary, which it may be, but we don't know, that feels like quite a punt to cut rates on an unproven technology.
I wanted to ask you about that because Joachim Nagel at the ECB says that AI is going to create more jobs than it destroys. That's pretty optimistic. Do you agree with that?
Let's wait and see. So it was interesting when we had all the kind of coverage of the Citrini paper on AI. We'd actually put a paper out last year which didn't get so much pickup, saying that in the kind of the extreme case of AI adoption, the unemployment rate of the US could go to 10% easily in an environment of 3% productivity growth, which is kind of what you saw pre-dot-com bubble. So we will see. Because
are you using it, David?
Are we? Yeah.
Are you using
AI? Yes, absolutely. Yeah, we're using it. Is it more than a productivity tool at the moment for me? I'm not sure. I'm kind of running huge models off it, not yet, but I'm a bit of a dinosaur, right? But we are using it and developing it. Are we at the point of changing hiring plans or really revolutionising the business? I'm not sure. Okay. And then you've got to extrapolate that out. So, you know, there's clearly a path where AI can be deflationary and start to have an impact on the labour market. But we put a paper out a couple of weeks ago. If you actually look at the labour market data today, it's not obvious that it's really causing the weakness or the low fire pattern that we're in at the moment.
David, thank you very much indeed. David Rees, Global Economics Head at Schroders, definitely not a dinosaur. One of the largest investors, meanwhile, in distressed securities worldwide says AI is being underestimated.
Well, I think most people are underestimating the impact of AI. Roughly 18 days ago, on a Friday, that a company called Block, which had 10,000 employees, announced that 4,000 of them were out. 40% of the workforce gone in one day because AI could do the work cheaper and faster.
That was Howard Marks, Oaktree Capital Management's co-chair and co-founder, speaking, of course, to Bloomberg at the Capital Markets Industry Conference. We're going to discuss more on how the AI theme is playing out later in the show. Stay with us for continued analysis. This is Bloomberg.
Welcome back. This is the opening trade. Now, this time last year, Goldman Sachs and Mackenzie saw the quest for European champions driving mergers and acquisitions across the continent. Fast forward to now, and a trade war and a hot war in the Middle East later. What is the story for European M&A? What is the outlook? Joining us now is Andre Kelleners, EMEA co-head of investment banking at Goldman Sachs, with us on set this morning. Andre, nice to speak to you. So we've been through a lot in the markets in the last year, and through all of that, there was so much expectation that we were on at the cusp of a big boom in M&A, and we did see some of that coming back into the markets. I wonder what Iran and the war in the Middle East has done to your expectations about M&A.
Yeah, we've been in I think we're in the third year of a 5 to 7 year cycle in M&A, and we've come into this year with pretty strong momentum last year. We're still up again on what was effectively the second highest year in M&A in this last year. And we see fundamentally, I think we're mindful of the greater uncertainty that the conflict is introducing into the broader landscape. Obviously, that's particularly transmitting through energy costs and energy prices in particular, impacting these regions. But when we speak to our clients, they remain quite forward-leaning. We had about 350 clients from 30 countries from across the region, some of the largest companies in the region in our building yesterday for our M&A conference. And we surveyed them on what they expect for this year, which we do every year. And the majority of them expects to do more this year than last year in M&A. Okay. And the biggest driver is growth.
Okay, so would you say then, so yes, higher energy prices, also higher yields in some cases, which might make some transactions more expensive, although some assets have also become cheaper to buy. So do you think then, I mean, has the war dented your expectations about M&A yet or not?
So far, we don't see a big shift in activity that's going on right now. I think the capital markets are much more sensitive and near-term sensitive, although I would say we had some very significant issuance in the equity markets and in the credit markets in the last couple of weeks. So markets remain quite open and robust. I think we're evaluating the timing of primary issuance to come to market. The pipeline for IPOs in Europe remains strong and remains robust, though, and we're quite confident for the year, but we're monitoring the situations. It's early days, and we'll have to see how this plays out.
So against that backdrop, of course, energy and commodities, defence even, are front and centre. Are you seeing more M&A interest within those sectors?
Yeah, so if you look at some of the themes in Europe, there's been a lot of M&A in the financial space. I think that's more broadly against the context of a desire for greater integration of financial markets, banking markets, capital markets in Europe. You can see the banking space, which has obviously had a very significant run from a valuation perspective as well, responding to it. There's a lot of focus on infrastructure defense, as you said, and reinvesting in those sectors in the region. And then, as you would expect, in particular in the context of the volatility we've seen in the energy markets, energy transition remains a significant theme, and that's where we're investing as well. And we launched earlier today a significant financing, the fourth financing for a Dutch company called Nebius, which is partnering with Meta and Nvidia on building out data center infrastructure in Europe in a 30 billion contract. And so the funding requirements for the broader infrastructure scale out and build up behind AI is also something that will drive increased investment in the region.
And how are clients thinking about transactions including Middle Eastern counterparties? Are those conversations still happening?
Yeah, so first and foremost, we're focused on our people and our clients in the region, and we're mindful of their safety and the human experience of living there in the conflict. We stay close to our clients in the region. There's obviously, I think there's a little bit less focus on activity at the moment in the region. But I think we believe that the dynamism that we've seen in the Middle East from an investment perspective will continue over time and will be resilient.
How is the sell-off in software feeding into you and the team and how you're thinking about this? How do you value these software companies at this point?
Yeah, so I think the sell-off in software is largely a market response to the enormous change that we've seen in the speed of change in the technology and the capability of those technologies in AI. And this is investors reassessing the terminal value, if you will, and seeing uncertainty of the terminal value in software. Now, at the same time, that means that's a recognition of the capability of what AI can do and the impact it might have. Now, when we look at the actual underlying dynamic in software, we don't actually see that happening at this point in time. So there's a lot of, I guess, forward-looking dynamic in the equity markets, as you would expect. But when we speak to our investing clients, in particular in the private equity industry, they look at their software businesses right now and they sort of see how they perform. And at the end of the day, there's a lot of companies that are still growing significantly, that are having meaningful margins. But as many sectors, it's a sector that will go through a transformation and adjustment, and the equity market is always the place where you see that first.
You mentioned European IPOs and a healthy pipeline, which is interesting because the broader narrative is Europe is failing when it comes to offering attractive listing destinations, particularly for the tech space. What is underpinning that relatively healthy picture that you outlined? What is the momentum? What else needs to be done from a governance perspective, regulators' perspective, to ensure that Europe can play that role?
Yeah, I think, look, it's important to remind ourselves the narrative about the IPO markets 2 years ago, the IPO market was failing and it was unavailable. And I think that was a reflection of a very dramatic repricing in the world that had caused a temporary dislocation in investors' ability to meet bid-ask on a price basis. But the market was there and the market was open. People didn't like the price. I think what we've seen more recently is the market has reopened, has opened up. Last year in October, we did the IPO of Verisure in the Nordics, which was the largest sponsor exit in history globally. And so clearly the market is open and is open in Europe. And when we look at the pipeline for this year, we have a very, very significant number of conversations with companies who are getting ready to issue. Obviously, we'll monitor how the events in the Middle East will impact volatility in the markets. But at this point in time, we feel quite confident about the market being then open for business.
Can you give us a rough number in terms of what the pipeline is looking like for European IPOs? Are we in single digits or double digits? What are we thinking?
The number of situations we're working on is definitely double digits. How many of those will then eventually come to market, I think we'll see throughout the year.
Andre, thank you very much indeed. Andre Kalinas, EMEA Investment Banking Co-Head at Goldman Sachs. Joining us now is Adam Linton for our Markets Live team, for a broader look at these markets. It's an odd day. Oil prices are down, equities up. That function makes sense. Bonds are modestly bid as well, and yet nothing has fundamentally changed in the Middle East. If anything, it gets worse. What is going on? What is the key catalyst right now? Is it the fact that there is a bit of oil that is getting through Turkey from Iraq, or is it the chip story? Is it semiconductors? Is it what's happening in Korea and Asia?
I think in terms of some of the upside we've seen for equities today, I think, definitely part of it is the stabilisation that we've seen in oil prices. Underlying earnings momentum does remain relatively strong. And we're also seeing the market just become a little bit more immune to some of the developments in the Middle East. And this is allowing traders, to re-enter kind of some of their favourite trades we've already seen in 2026. Because let's not forget, it was already a relatively bullish equity backdrop before this. I think the source of concern for me is, just how long energy prices do stay high. Because even if they need to really come down. Because if they stay high, and they're still significantly higher than they were pre-conflict, and there's energy implications from a macro perspective, they'll continue to compound on themselves. And that will begin to show up in the data, and that could refocus minds. And like I say, we're not really too much closer towards getting an off-ramp to reopen the Strait of Hormuz. We've still got Iran attacking energy infrastructure in the Middle East, and we've still not really got a clear timeline of what the US is looking to achieve here.
And so in the mix of all of that, we get a Fed rate decision, Adam, which I'll point out as a sort of public service announcement. Of course, in Europe, comes an hour earlier than we are used to, so we'll be alert to that. But what is the big picture expectation that you have going into the last Powell press conference? Probably. I mean, we don't really know how the confirmation of his successor happens.
Yeah, so I think, obviously with the Fed, they've got a dual mandate, so we're looking to see how they balance upside inflation risks and downside risks in the labour market, and kind of how that exposes itself onto the dot plot. In terms of short-term trading opportunity, a lot of attention is on, do they keep that one cut or do they remove it? But, what I would say is that at the best of times, those dot plots have relatively limited predictive power. And, given that we're going to see a lot of messaging about how uncertain the Fed is about the path ahead, those, dot plots will have even less consequence. Particularly when you consider that ultimately this was a bit of a lame duck Fed. They weren't expected to cut until later in the year anyways. And then I think, when you consider the market's already moved quite a fair bit and done a lot of repricing for the Fed, I don't think there's going to be too much traction in the market. Ultimately, the Fed is doing what we're all doing, and that's waiting to see how events play out in the Middle East.
When you look at the European central banks, the ECB, the BOE reporting as well, deciding tomorrow. Are we on Wednesday? Yeah, tomorrow's Thursday. Is it that markets are bound to be disappointed? Is it that central bankers just can't be hawkish enough?
Yeah, I think, what we saw since the onset of the conflict was this really mechanical relationship between rates and energy prices, where we almost trade them on basically a tick-by-tick basis. And a lot of that was, a clamour to kind of reprice a rerun of the 2022 Ukraine playbook. But, as we've discussed previously, labour markets are a lot weaker. That dampens the chances for second round effects. Policy is already more restrictive, and some of the rises in energy prices have been a lot less disorderly. So I think, markets maybe got a little bit over their skis, and we'll kind of see that be brought into focus with central banks this week, who will also be attuned to the negative growth implications.
Okay, Adam Linton from our Bloomberg Markets Live team, thank you so much for that. And remember, you can get up-to-date analysis and insight from Adam and the rest of the team by going to MLIV Go on the terminal. A couple of stocks to be keeping keeping our eye on today because of all the corporate news, UniLever and BHP. UniLever said to be considering potentially separating out its food assets.
Yes.
So that's one to watch.
It's much less food than it used to be. I'm kind of surprised, recapping this morning, how much food they still have, because it really had pivoted so much towards more domestic products outside of food. So that's interesting. I mean, it's breakfast appropriate to talk about Marmite, isn't it? It's 7:53 here in London.
Hellman's mayonnaise. I don't know. Can you have that on your dollop that on your cornflakes or something?
Stick with the Marmite, but
stick with the Marmite.
Not on the cornflakes.
Fan of Marmite?
No, nor the Hellmans.
Oh. No, I'll steer clear of the Hellmans. The Marmite's good though.
I've got
billions of dollars potentially.
From that into BHP. We're also watching that. Copper.
Yes. Copper, BHP, new leader at the top, CEO, a lot of experience in terms of iron ore. The focus on copper. What it tells us about the future of this business, that by all accounts, Mike Henry left in pretty good shape, with of course cash on the balance sheet. They didn't make that acquisition, so let's see what is entail.
And both of these
for this new leader.
Pop at the start of trade. That's the expectation we're seeing, and European equity market futures are pointing higher as well. To your point earlier with Adam, Tom, not entirely sure what the catalysts are, just day by day measuring up where we are on the risk on, risk off narrative coming out of Iran. Any sense of whether we're getting escalation or not? That is certainly at the forefront for markets. This is Bloomberg. Welcome back to the programme, everybody. A few minutes to go then until the opening trade for this Wednesday morning here in Europe. And cast our minds back to the session of yesterday on Wall Street. And markets over in the United States didn't do very much after European markets has closed. That's what the yellow line marks, of course. So we didn't have a huge amount of indicator as to where we would go here in Europe from the US session. But we do have a weaker oil price this morning, and that seems to still be instrumental in terms of risk appetite. So the markets, the oil price, a little bit weaker this morning, choosing to focus on the oil that is getting through either the Straits of Hormuz. Of course, much reduced volumes, but some of it gets through. The pipelines that are being explored in Saudi Arabia, in Iraq, through to Turkey, all of that in the market's thinking, rather than the market focusing on areas of escalation. And Tom, there are areas where we're seeing escalation, but the market is choosing to focus on things that paint to a slightly more benign picture and a weaker oil price. And that puts the futures on the front foot.
It does indeed. 3 straight days of gains now for global stocks, and European futures pointing higher by 0.7%. That was the gain that we saw by the close yesterday on European markets, up 7 cents. Currently futures pointing in a similar direction today. FTSE 100 futures currently flat. Energy will not be playing that role that it did yesterday. That was the leading sector yesterday. DAX futures pointing higher by around 0.5%, looking to add 127 points over in Germany. Lizzy, what are you looking at?
Well, we mentioned UniLever said to be considering a potential separation of its food assets. Barclays analysts not liking that. They're saying we don't think there's much investor appetite for another 18-month painful Magnum-esque exit process. So watch how that fares. BHP naming a new CEO in Brandon Craig, and Heidelberg Materials, one to watch, upgraded. Morgan Stanley seeing it as an entry point, gaining on Tradegate. Anna.
Yeah, so those individual stocks certainly will be in focus. And Tom's point, of course, valid, that we have a weaker oil price and London plays a different role perhaps then. Yesterday in session then, energy stocks were to the fore. If that turns around, if energy stocks are weaker, that plays out differently for the energy names listed in London. So let's have a look at where we are opening up this Wednesday morning across European equity markets. The expectation is that we will be broadly positive. That's what futures have been telling us, and we are expecting underperformance in London, and that is broadly at this very early stage what we are seeing. So the FTSE 100 is flat to negative. The Stock 600 up by 0.2%. So we'll watch those energy names, how much they're responding to the weakness in the oil price. It was more pronounced a few hours ago, but still down by more than 1% on Brent. So we'll certainly watch how that spills through into various markets this morning, how that changes expectations around inflation and where we head from here on central banking narratives, because that's a really big topic of this week, of course. The CAC 40 is up by 0.5%. The IBEX over in Spain up by 0.5%. Tom, what are you seeing in these markets?
Across the sectors, top of the list, travel and leisure is the biggest gainer right now, gains of 1.2%, followed by banks gaining 1%, that sector. Basic resources also getting a lift, up 0.9%, and tech is performing well, worth reflecting on a very, very positive session over in Korea with the Kospi up on semiconductor optimism and some changes in listing rules there. So tech is up in Europe currently 1%. On the downside, telecoms getting a bit of a knockdown, 0.8%. Utilities also softer by 0.5. Food and beverage weaker by 0.4. You've got about, six sectors currently in negative territory, most pointing and in positive territory with travel and leisure at the top. Travel and leisure gaining 1.3%, followed by banks.
Well, Tom, you talked about some of that semiconductor optimism. Just to pick out some individual names, ASML up more than 2%, BE Semiconductor, ST Micron, all in the green this morning, Infineon up 1.6%. Just going back to those stocks that we'd flagged earlier, UniLever is actually down 0.3% on this potential separation of its food assets. BHP named a new CEO, they're up 0.6%, and we're waiting for Heidelberg Materials still, Anna.
Yeah, so a lot being repriced this morning, it seems. A bit of a rotation from yesterday then. So yesterday we saw energy names at the top. Today we see travel and leisure names at the top. It seems the market flip-flopping in its perception of where the gains and losses might fall from what is taking place in the Middle East. 2 minutes into the trading session here in Europe, let's bring in our guest for the top of this hour, Sophie Wynn, portfolio manager and strategist in dynamic asset allocation at BNP Paribas Asset Management. Sophie, nice to have you with us. So let's think about where we are on the energy story and how much that is dominating your asset allocation or not. Are you able to look through what's happening with energy prices and invest around other themes, or is that still the dominant narrative 3 weeks into the war or into the third week of the war?
I think it's still the dominant narrative, and I think all rest on the duration of the conflict. So I think the SPR release, but the fact that the oil market was oversupplied before Iran is buying us some time. So I think a month or so. But the longer that conflict lasts and the longer the Strait of Hormuz stays closed, the longer, I think the more likely we could have an energy shock, which could translate into a growth and a recession, which is at this point totally dismissed by markets.
Yes, that's interesting. And I want to ask you about, we will no doubt talk about that in many different ways in this conversation, but I want to ask you about some of the other themes, because you point to, in your notes, something that we've talked about in the first hour of this programme, and that is that analysts are not cutting their expectations of corporate profits just yet, and that's something that maybe is putting a floor under expectations and a floor under stocks. Do you think that's because they just haven't got round to cutting them yet, or that they're right to hesitate and say, hang on, this might only last weeks, let's not do anything just now?
I think it's basically that, as in when you look at the Strait of Hormuz, I think it's in no one's interest that it could stay closed. And the fact that you have, recently some tankers with Iranian taking some toll tax on the way or not, it's kind of giving a bit more confidence. I think what's different from 2022 is the fiscal leeway is very different. So it's in no one's interest that you've got oil price spiking at 150 or 200. So on that, the fact that markets are betting on a Trump taco and a quick resolution or Strait of Hormuz reopening is making investors and at least portfolios not de-risking, just adding hedges, knowing that before Iran, the rotation we got on the equity markets already triggered some de-risking.
So we don't discount those earnings forecasts and those dividend expectations and say they're out of date. We trust them for now.
Still, I think it's basically if Iran goes away and tankers go through the Strait of Hormuz, is the story we got is tax rebates in the US, fiscal spending that's moderately focused on infrastructure, defense. So all the story will come back with more or less worries about private credit.
You just wonder how TACO can remain the base case when, as many leaders have pointed out, Trump may have started this war, but he may not necessarily be able to end it. Let's say it does end. Let's say the Strait of Hormuz does reopen. How much would the dollar fall if that were to happen?
So you could have the Strait of Hormuz reopening without some clear resolution on the conflict. All I care about is whether you're going to have these 80 tankers going to the Strait of Hormuz in the next couple of days or not. If that's the case, I think the risk environment would be more favorable. But I think your point on the dollar is really interesting, because what we saw since the start of the conflict, so it's been going on for like almost 20 days, the dollar didn't go up as much as expected. So it was much more an unwind of the very crowded longs versus dollar, and some shorts in euro and Asian currencies that are basically the fragile kids that usually are kicked when you got some energy supply problems. But the dollar didn't rally as much.
It's really interesting to know what you consider not the end of the war, but the trigger to be back on, risk on. And of course, we've seen lots of hedges that we would traditionally rely on not working, gold, treasuries. How are you thinking about protection from here? Now, as you say, we're entering the third week.
So I think what's interesting is the fact that gold didn't react to that. I think it has to do with exactly what you said, as in earnings expectation not revised, and market not pricing the left-tail risk yet, as in because you're thinking about TACO. So there's been this ongoing positive correlation between equity and bonds, and gold, I think, suffered a bit on top of being high momentum. So there's been like this liquidation of some of your high winners in your portfolio to protect the portfolio. But that, I think at the end of the day, looking for portfolio protection, there might be some reallocation into commodities, but also currencies and equity markets that tend to be much more commodity exporters, which benefit from the AI spending.
Sophie, it's a big, big week, of course, for central banks. And when we think about central bank responses to the energy shock and the earnings story, what expectations have been factored in to earnings around the trajectory for rates? Essentially, if we get hawkish central banks, does that derail earnings expectations?
I think the repricing we got at the front end of the curve was pricing stagflation. But if you think about it, how much fiscal leeway broadly do we have this time compared to 2022? So I think it's a bit wrong in the sense that if we really have oil at 150 or 200, my guess is we're going to skip the stagflation and end up mostly pricing a recession because this fiscal support is not the same as before.
That's the second time you've said recession. So what do the equity markets do in a recessionary environment, given that you think they haven't priced that outcome? What are we talking like 10% downside? What are we talking about?
I think you could have more than. So what's really interesting, if you look at the equity risk premium, so like trying to look at the relative valuation between treasuries and the S&P, it has fallen since the start of Iran. So it's really telling you that treasury market is pricing something, but the equity market is also pricing another thing, when I think most portfolio have added so much hedges on that they are for now surviving and buying some time until we get a resolution. But if we really have recession being priced, I think that's where the asymmetry is, rather than Strait of Hormuz reopening and how much rally in risk assets you're going to have.
But recession is not your base case?
It's not.
No. So the base case still assumes short conflict and everything else flows from that?
Yes. Yes.
And what are the assets that we have not mentioned, Sophie, that we should be mentioning that fit in with what you've just been describing? We've talked about how metals have not performed as expected. We've talked about the short end of the rate curve, talked about stocks, talked about energy markets. Is there anything that we're missing in terms of that whole narrative as it fits together?
I think the shopping list you need to have is basically, if we have energy prices kind of stabilizing, are we going back to AI spending? And the semiconductor part of the equity market suffered a bit because of worries about energy supply, how there could be force majeure declared on some of the semiconductor supply chain, but also on helium. So that's why the Asian equity market, on top of being high momentum, suffered the most, so Japan, Korean equities. But I think if you need to think about what's ahead, and if we have energy supplies back on track, is maybe in terms of EM reallocation, still go into Asia, which suffered more than the rest, go into LATAM, which continue to be commodity exporters. Europe remains to be seen, because I think it's still going to be the problem on how fast the gas storage is going to be refilled during the summer month.
So you mentioned AI and tech, and we've seen a revival of kind of animal spirits, particularly when it comes to the semiconductors. Again, we're seeing that reflected in the Asian session today. Yep. What is your favoured? Is that a factor that brings you back into Asia, as well as the fact that it sold off most aggressively because of the energy impulse for Asia and the dependency there? How do you want to be playing the AI theme if it comes back with conviction?
I think it's still trying to favour the molecule, so that's why I think the Asian markets are very attractive, on top of super supportive corporate governance that we don't see anywhere else. So you have this double support, like amazing EPS growth for this year, on top of like potential also some multiple expansion due to corporate governance. So I think, Asia is where you should be at this point.
Okay, Sophie, great to see you. That's Sophie Wynn, Portfolio Manager and Strategist in Dynamic Asset Allocation over at BNP Paribas Asset Management. Thank you. Let's check in on the core six now. How are they shaping up this morning? You've got LVMH up 0.8%. ASML on that semiconductor interest, Tom, that you've been flagging, up 2.5%. Schneider up nearly 2%. But Rheinmetall, Novo Nordisk and Nestle in the red. Let's check in on some of the individual stocks on the move with Charlie Wells. Charlie.
Good morning, Lizzy. So I am looking out this morning for some optimism kind of washing over from this big Nvidia event, their largest event of the year, painting a picture of some positive forward momentum there at that event. That's spilling over here into Europe and a lot of these chip makers. You see ASML up well over 2%. You see a lot of other green on the screen. It's sort of a relief to sort of finally see a little bit of optimism in these markets. So we're starting to see some of that AI trade come through. Now, we've got an opposite story to tell when you take a look at sort of the kind of old type of tech, the old kind of consumer tech. You think about HelloFresh, right? This was a few years ago, this idea that consumers would use a lot of these startups to get services delivered to them. They delivered a disappointing outlook for the year ahead. They are down almost 7% here in Europe early in the morning. And one of the points that they were talking about was bad weather, literally how bad weather had just impacted some of the deliveries. You know, they deliver these meal kits, they deliver these food services. And look, we're down even more now in early trading. So really kind of having a negative impact and then having that outlook not look great. So that is a German meal delivery company. We're going to stay in Germany, but go to Heidelberg Cement here. They are up over 3%. Now, we had a really positive note for them coming out of Morgan Stanley talking about cement and how effectively pricing there is sticky, because there's been concern in Europe and across the board about carbon pricing, right? Is that going to change the dynamics of how pricing has to work in cement, which is so crucial for buildings, so crucial for a lot of these infrastructure projects. We've been hearing a lot about infrastructure recently, and that research note talking about the stickiness, the importance of the pricing of cement. So that is Heidelberg. Let's flip and take a look as well at a little bit of the kind of infrastructure story that kind of brings in not just infrastructure, also a little bit of AI, a little bit of electricity. We've got Bolloré. So they're up nearly 15% this morning. They were talking recently about an extraordinary dividend that they could be offering. This is a company that does electricity storage, among many other things, an energy logistics company. We think about AI. What do we need? We need energy storage. So again, we're seeing optimism across the board when you get into that energy, that infrastructure, that space that is kind of coming from some of this optimism on AI.
Okay, Charlie Wells, a man who knows how to get Anna Edwards' attention as well. Cement, infrastructure, electricity.
Hey, I like stories I can see.
Some you can build on world. As well.
Yeah, very nice.
Coming up, it was bad, wasn't it? I can build better than that. Right, BHP announces Brandon Craig as its new CEO, as its mining giant. There we go, more commodities on top of our cement story. Sets its sights on copper. More on that next. This is Bloomberg.
Welcome back. This is the opening trade, 18 minutes past 8. So 18 minutes into a European equity market session that has European stocks going higher, up by 0.6%. And one of those, Lizzy, is BHP.
Yep, shares on the rise this morning, up a neat 0.6% after the London-listed mining giant named Brandon Craig as its new chief executive. Craig will replace Mike Henry, who's led BHP for more than 6 years. And for more on this, we're joined by Martin Ritchie, our metals and mining reporter out of Shanghai. Martin, what should we know about BHP's incoming CEO? He seems to have been at the company a long time.
He is. He's very much a BHP man. He's been there for more than a quarter of a century. And I think that, this is a kind of safe pair of hands appointment. It's someone who knows BHP very well. He's worked, first of all, in the coal business. He's worked in sort of maintenance around the world. He's been head of the very important West Australia iron ore business. And he's been head of Americas, where copper features as a big asset with some of the biggest resources in the world there, and metal, obviously, that BHP is looking much more closely at. He was at a press briefing this morning. Some of the notable things there was really real caution when it comes to M&A. The word discipline he mentioned 8 times. The chairman also underlining that they wouldn't go after any other assets unless they were exceptional and they have a lot of options of their own. So a kind of continuity choice, I guess, in Brandon Craig.
Yeah, and so that's interesting, mentioning discipline a lot then. And M&A in the sector and overspending on CapEx are perennial fears of investors. What are analysts saying then about what this change at the top means for the mining giant, Martin?
Well, obviously, the broader context for any change in the top at mining is the shift from kind of the old traditional commodities, or so-called traditional commodities like iron ore, which BHP and Rio have, made a huge amount of money of over the past 20 years, to things like copper, which I just mentioned. That was also a big theme of the press conference this morning, how they're going to grow in copper. And in fact, an interesting thing was a sort of more of a geographic shift almost that they flagged, a movement in the centre of gravity of the business, I guess, from China, which has obviously been the big earner for a long time and will continue to be. But he did mention wanting to build stronger relations in the US, in Chile and Argentina, which all have up-and-coming big copper mines, where also governments are very focused on sort of building up supply chains. So that was another interesting kind of structural point there in terms of the focus going forward.
Well, Martin, as we talk about, good morning, as we talk about supply chains, if we zoom out, what is the Iran war doing to your world of metals?
Yeah, the most interesting one as a prism to look through the conflict in the Middle East is really aluminium, because that region accounts for about 9%, 10% of production. The most important thing to note is that these smelters in the Middle East, they cannot get raw materials in at the moment. They can't get the metal out, but the bigger problem is they can't get raw materials. And if they run out, they're not going to be able to keep producing the metal. So a lot of kind of ructions in the aluminium moment, especially around like how long, is it weeks or is it months that these producers can keep going? And if they can't, in the case of a long war, and it does look like we're heading in that direction at the moment, what does that mean for all the buyers in the rest of the world? We've seen negotiations, for example, to Japan. Suppliers already ramp up prices. We've seen premiums in Europe and the US. And overall, it's just that adds to the kind of headwinds for the aluminium market, which was already facing kind of disruptions and deficits this year.
Martin, thank you very much indeed. Martin Ritchie with that update out of Shanghai for us in terms of the broader impact of the Iran war on the metals space, but also change at the top, of course, at BHP. Martin, thank you. Meanwhile, to oil prices dropping this morning after Iraq signed a deal to resume crude exports via Turkey, avoiding the Strait of Hormuz. For more, let's bring in Bloomberg's energy reporter Anthony Di Paola joining us from Dubai. Anthony, how significant is this then, not just for Iraq and their revenues, but of course for the global oil markets?
Yeah, good morning, Tom. I think it's more significant for the first. This has been an issue for Iraq for a long time, trying to work out some of the kinks of their northern exports. It's been a problematic situation for years, really. They've had a pipeline dispute over pipeline fees with Turkey that stopped flows completely. Once they agreed to resume flows, then they had a dispute with the Kurdish region over payments and internal transfers of who would get the income for the oil and how that would go to pay for government services. So this has been a long process, and it comes at a terrible time for the global oil market now, because we do have the Strait of Hormuz completely blocked off. So we don't have any oil, for the most part, going through Strait of Hormuz out of the Persian Gulf, and that's impacted Iraq too. They've had to shut in about 3/4 of their production, so they really need that northern export route. At the moment, it looks like they're going to export about 500,000 barrels a day through that route. That's been the agreement, and that includes some oil from some northern fields in northern Iraq that are operated by the central government, and then some fields in the Kurdish region that are operated by international companies. So what will be really important to watch for the global oil market is if they can keep that agreement together and keep that production going. So they've had these issues of, again, as I said, payment disputes. The international companies in Kurdistan, in the Kurdish region, were declining to produce because they didn't have an agreement for payment from the federal government. There's also the security situation, because Iran or Iranian-linked militias have been bombing fields in the Kurdish region using drones, using missiles, and so that's caused also a shut-in of production there at various points as well too. So they need to keep the economics and the politics of that pipeline agreement and the payment agreement running, and they'll need to keep the security situation underhand in order for those producers to keep pumping that oil and keep getting that to the global markets, Tom.
Anthony, is anyone getting through the Strait of Hormuz at the moment? And if so, whose tankers are they, and what does that tell us?
Yeah, easy answer to that. It's Iran. So Iran has closed the strait effectively by its threats against shipping, by having hit a number of tankers inside and outside of the Gulf, just around the Strait of Hormuz. So that has effectively closed it off to tankers who are refusing to go through there. The vessel crews, the owners. However, we have seen some Iranian tankers passing through the strait and exporting some oil. So we had bombing of Karg Island, which is Iran's main export hub. That was over the weekend. The U.S. forces bombed that, took out some naval facilities there, hit the airport, left the oil infrastructure intact. And in fact, the Iranians said that on Saturday they were already loading tankers from there and exporting from there. So we have seen a number of Iranian tankers go through. We did also see some other vessels, some vessels going to India carrying LPG, which is a vital cooking fuel for them, a vital fuel for petrochemical plants, and a tanker going to Pakistan as well.
Anthony?
Yeah, so some oil is going through, mainly from Iran.
Some are getting through. Anthony, thank you very much. Anthony de Paula, our energy reporter. Coming up, we speak to Vincent Rouget, the CEO of UniLever Radamco Westfield. How is retail consumer appetite holding up right now? We'll talk commercial real estate. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and we are seeing oil down today, but the energy shock still likely to hang over that Fed decision later on today. But it's giving us reason to be a little more risk on. Hence, the Stock 600 up 0.4%. The FTSE, though, the underperformer because of its exposure to energy. Tom, what are you seeing under the hood?
Yeah, lift the lid, and you're looking at banks outperforming. Interestingly, travel and leisure coming back as well. And on the downside, you're seeing some weakness for food and beverage. Across the breakdown of the Stock 600, there is that optimism more broadly. So you've got 410 stocks in positive territory so far this Wednesday, this trading session. On the downside, 181 stocks lower. Volumes are lighter, though, worth noting that. Currently down about 34% versus the 20-day average. So slightly thinner volumes. Let's flip the board and have a look at some of the leaders, and then we'll break it down for you in terms of the laggards as well. You have seen that momentum again in Asia when it comes to semiconductors and the trade there, and that really lifted the Kospi. A very powerful session over on the Kospi. The names like Samsung, SK Hynix getting a really strong lift as well. The view from Nvidia remains very constructive in terms of the demand. So you're seeing ASML gaining 1.8%. on that story, it seems. Bolloré within the electricity infrastructure space. Look at that, big jump, about 14% on that company. Advanced the most in 5 years after proposing an exceptional dividend yesterday. In the cement space, this is an Anna Edwards favourite, up 3.4% after a double upgrade from Morgan Stanley analysts who now see an attractive entry point. On the downside, let's flip the board. Novo dropping. There's competition heightening. We've talked about the competitive threat, of course, to Novo. Rivals providing more weight loss treatments, including Structure Therapeutics. So Novo's down 2.2%. Logitech, interestingly, within tech hardware space, falling 5%. UBS cutting its recommendation to neutral from buy. And UniLever Bloomberg reporting, suggesting that they could spin off the food business, the rest of the food assets, currently just down 0.5%. Anna.
Let's talk about some of the other stories we're keeping across them this morning. Tom, PIMCO says that the mounting strains in the $1.8 trillion private credit market are giving investors a reality check. Lotfi Karoui, a multi-asset credit strategist, says he expects a deep rethinking from private credit investors on where they deploy capital and the liquidity risk. Several high-profile blow-ups and redemption pressures at some global private credit funds have added to investor concerns about loan quality. Iranian attacks on Israel and Arab states in the Persian Gulf continued overnight with a fresh wave of missiles and drones targeting the UAE, Saudi Arabia and Kuwait. The attacks followed Iran's confirmation of the assassination of its security chief, Ali Larijani, in an Israeli strike. And Japanese Prime Minister Sanae Takaichi says she's facing a, quote, extremely difficult meeting with President Donald Trump after the United States president criticized the country for rebuffing his demand for help securing the Strait of Hormuz. Takaichi's trip to Washington tomorrow is her first since winning a sweeping mandate and had been viewed by Tokyo as an opportunity to showcase the strength of the US-Japan alliance. Lizzy.
Anna, let me just bring you some breaking lines from the UniCredit CEO, Andrea Orcel, speaking at the Morgan Stanley European Financials Conference. Of course, earlier in the week, Commerzbank got that takeover bid from UniCredit. This was on Monday, and now Orcel is saying that Commerzbank offer was intended to break the stalemate here. He says they need face-to-face engagement with Commerzbank. They've been unable to engage with Commerzbank until now, and they need to put all the cards on the table in these Commerzbank talks. It's interesting because you were speaking to Bettina Orloff, the Commerzbank CEO, just yesterday, and she seemed to me quite baffled by this offer and what the intention was from UniCredit.
Yes, I wonder if this all comes down to whose move is it, in this particular game of chess, because UniCredit clearly thinks that they weren't getting engagement from Commerzbank. Commerzbank says, well, you didn't present us with something to engage on. You didn't come to us with an offer, and so there was nothing to talk about. So, yes, we're still caught in that dance, I suppose, ahead of what could become a big M&A story, a big cross-border banking M&A story for Europe, or perhaps won't.
UniCredit up 0.9% so far in the session. Let's go for banking. From banking to what's happening in terms of retail with a company that has a very significant global footprint. Unibail Rodamco Westfield is one of Europe's largest commercial real estate companies and widely considered the world's biggest operator of shopping centres. Their network includes 66 malls in the US and Europe that contribute to the group's €49 billion asset portfolio, with retailers and developers assessing, of course, inflationary impulse from the war in Iran. We're joined now by Vincent Roger, CEO at Unibail Rodamco Westfield. Vincent, good morning. Thank you for joining us. Let's start on the story that is still dominating the headlines then. What is the potential inflationary hit, the squeeze on consumers that could be felt like by a business like yours? Are you starting to see any impacts as a result of supply chain challenges and higher costs?
Good morning. Not at all. We are seeing no impact on footfall and visits in our malls to this date. So we are in a position now, because of the investments we made in technology, in AI and data, to follow on a real-time basis the traffic in our malls store by store. And when we look at this data in 20 malls in Europe, which are equipped today, we see flat to marginally increasing traffics. So on par with a normal week, I would say, since the start of the conflict. So our business is doing well.
How much resilience is there in the portfolio and in the companies that operate in your malls to higher prices and inflation, if that does become a more sustained problem?
Look, I think historically over many decades, we've shown in this business that we were able to capture inflation through our partnership with retailers. It's been a success for 50 years on some of those most dominant malls that we own in our portfolio. And this is the reason why we feel very comfortable, at ease with typical shocks like this, because we see that historically we always emerge stronger. So the business is doing well. That's what we've shown with COVID as well. Some of our top retailers had a fantastic performance over the years, if we compare 2019 to 2025. And that's why we keep on pushing on our platform for growth agenda over the next few years.
But what about retail investors? That's consumers, but you've got retail investors who've been holding on, real estate investors, I should say, holding on for lower rates. And it may be that they don't come because of this war and rates staying higher for longer, perhaps.
Maybe it happens. As you know, real estate is a cyclical business. So there has been cycle on and off for quite some time now. And I think what's important is to drive growth and organic growth. And that's what we're focused on. We believe that prime retail real estate offers a fantastic value proposition. We have high yield, we have growth, we have inflation hedge. And that's the reason why we've been a success over the last few years and why we emerged stronger after a few years of deleveraging that we concluded last year.
I think you'd been exploring partnerships in Saudi Arabia. Is that still the case, given the war?
Yes, absolutely. It's an industry first. So we are extremely proud to have made this deal with our partner, with the leading operator of shopping malls in Saudi Arabia. We see it as a growth market that is equipping itself. There are tremendous investments. We don't want to grow our balance sheet and grow our debt basis. So it's a fantastic way to keep on growing, add to the organic growth profile we have on our own portfolio in new markets, get to learn those markets, but also share the technology, the expertise and the know-how of our teams, which is extremely valued by leaders in their own market.
Can I ask you about your US portfolio then, Vincent? Because when the Westfield acquisition took place, you took on quite a lot of exposure to the United States, and the view initially was that you would want to sell those assets. More recently, you've maybe indicated you might hold on to some of those. So what's the latest thinking on US assets?
We confirmed we were staying in the US forever. I think
forever.
Forever.
That's a long time.
That's a long time. That's the time of real estate as well. When you own those fantastic piece of infrastructure, urban infrastructure as they call them, like these are generational assets, well-performing, long-term growing, fantastic. What we've done in the US over the last few years, under the pressure of deleveraging, we sold some of the regional malls very early on in the cycle, so we achieved good pricing, and in the end, we did the disposals in Europe at very good price. And at the end of those few years of deleveraging, what we realized was that we had retained some of our best assets, which were booming in the US. Performance is stellar in Century City, in UTC San Diego, and so on. And we felt like it makes total sense for us to operate on those flagship malls. We have a number of them in the US, and they are fully part of the collection. And we're seeing a lot of potential in the US market and the US economy.
Vincent, can I ask you a big picture question about what you've learned about bricks and mortar retail and how it competes with digital, or how it embraces digital retail channels? Because we constantly see different parts of the economy being disrupted by digital technology, now being disrupted by AI technology. 20 years ago, we might have thought, we're all going to buy things online, shops are going to disappear. Shops did not disappear. They just had to reinvent themselves. What have you learned through that long process of reinvention?
We learn, and I see that we've been constantly on the ball, adjusting our model, speaking with the right and teaming up with the right retailers that created desirability, attractivity, broad visits, footfall, and are at the center of the customer interest and obsession. I think what's extremely interesting for us is that flagship retail answers to a need from Gen Z generation. And we see it in the numbers. The proportion of Gen Z customers in our malls are basically 10 points higher than in general population. That's one of the key reasons why we've been successful over the last few years.
Is that it's about sociability? What is that need?
Exactly. It's human connection. I often say we are in the business of human connection. So we offer a proposition. Many people want to live in a cloud, in a dematerialized world. And we see that at the same time we go that direction, we see an absolute need for human connection, community, meeting people, meeting places, third places. Your headquarters here is an amazing example of that. I guess people want to work here.
Yes.
I
get to meet these people every morning.
Well, the kids have got to take their selfies somewhere.
Do you know what? So my wife's from Los Angeles, and she as teenagers, they spent all their time the malls were where they hung out.
In the Philippines, it's because of the aircon.
Whatever takes you there, something takes you to that communal shopping experience. But you are a business that's embraced the digital side of things as well. Our colleagues were talking to us about how you've planned media revenues of 200 million, and this is to do with advertising, better data, informs more successful advertising. What's the latest on that revenue stream?
This is the part that is extremely exciting when you have those urban infrastructure. You can build on, you can create new levers and new areas of growth. That's an area we invested over the last few years while we were deleveraging in technology, AI-driven software that allows us to understand in a much better way the customer journeys in our modes. Point by point, store by store, the store which are visited before one visit, after, and so on. And it's going to develop those insights where we're going to craft a better game and improve the way we can drive further sales at our retailers. That's the recipe for success and long-term growth for us.
Was it $200 million that you were targeting by 2030 from the digital business?
Yes, exactly.
Are you on track for that?
Yeah.
Could you top that? Is that conservative?
We think it's a pretty good baseline. I will remind you that we were generating roughly 25 million euros back in 2021 when we launched this initiative. And it's a great example over 10 years. We will have created, together with the franchising business, with the first in Saudi Arabia, we'll have created 10% EBITDA over a decade, more or less, when we hit those targets. So this is the way we constantly reinvent ourselves. We constantly improve our footprints, our assets. And what's extremely interesting for us is that we can compete head-on with online, with those new data tools and new insights, because we're able to use those as levers to qualify our audience and to have the right discussion with retail partners in order to drive more business for us. This is the solution for the future and long-term growth.
I think you also develop offices and work conference venues, right?
Yes.
How's that going? Is it still something that we need in 2026 in the same way that malls are still relevant despite the e-commerce boom?
The very best ones, yes. It's a resolute yes. Convention exhibition, we've been following the same trend of recovery as in prime retail. So despite any scare whether this business still sustain, I think it's doing very well. We hosted the Olympic Games of Paris. It was a tremendous success, and we had great performance last year as a result of that. And what we see as well in offices, we have an amazing project that we're developing south of Paris, Tour Triangle, which is a new flagship, high-rise over there, which is quite rare. When you have exceptional product, the demand is there. Whatever the environment, we proved that basically in La Défense, in a very tough market during COVID. We fully let our asset at 50% premium to market trends because of the quality of the assets. So there's a market for that. We believe strongly in it.
Vincent, thank you very much.
Thank you very much.
Coming in. Vincent Rouget, CEO at UniLever Rodamco Westfield. Coming up, Greek Prime Minister Kyriakos Mitsotakis says Europe will not join Trump's military efforts in the Iran war. We're going to hear from the Greek Prime Minister. This is Bloomberg.
Welcome back to the opening trade. We are 47 minutes into a European equity session that is broadly positive. Even the FTSE 100 joining the move to the upside, up by 0.2%. They're held back a little bit by some of the food, beverage, tobacco names that are weaker, telecoms, healthcare. Those are the things that are weaker. To the upside, though, banks, construction materials, travel and leisure having a good day, moving higher as far as those sectors are concerned. Lizzy.
Meanwhile, in geopolitics, European leaders are standing up to US President Trump, saying that they won't help his campaign with Israel against Iran.
We are not a party to the conflict, so France will never participate in operations to free or reopen the Strait of Hormuz in the current context. However, once the situation gets calmer, and intentionally, this term is broad enough, meaning once the core of the bombing has ceased, then we are ready with other nations to take on other responsibilities, such as an escort system.
Now, the sharpening rhetoric is a high-stakes gamble for Europe, as the US president has threatened, quote, very bad consequences for NATO if he doesn't get his way. Here for more is Oliver Crook, Bloomberg TV's chief Europe correspondent. Ollie, good morning. This feels a little bit to me like Europe's Love Actually moment. Talk us through the calculus that has led to European leaders changing their position towards the US here.
I think despite all the efforts by many of these European nations, the ones particularly most exposed to the possibility of the United States pulling out of NATO, so the Baltic nations, Poland, Finland, we heard from Alexander Stubb yesterday, saying that we should be open to these ideas and these conversations about helping the United States in some way in the Straits of Hormuz has just been sort of overpowered by an overwhelming feeling in much of Europe and all of the sort of G7 members of Europe, and we should say the G7 members apart from the United States, saying that this is just a shade too far for any sort of active participation in trying to reopen the Straits of Hormuz. You heard it first from the UK, from France. You heard it there from Emmanuel Macron. You heard it very interestingly and notably from the Germans, who at the sort of outset of this war, when the bombing began on that Saturday, had been very encouraging of the U.S. military action and really was on side, but then came out this week very clearly saying that this is not a conflict for Germany and they don't have any sort of active role in it and they won't take any active role in it. Now, the French did say, as you heard there from Emmanuel Macron, that they could support in some way once things calm down, that they could, join a mission to help sort of the flow of cargoes through the Straits of Hormuz. But again, that will come after the sort of war ends in all kind of substantial ways. The other thing that I think is important and something that we should pay attention to that is happening tomorrow is that the European Union will vote and move forward on ratifying their trade deal to the United States. So maybe an effort from the European Union to give something in return for basically withholding that support on the Straits of Hormuz in Iran.
Ollie, Ukraine and its role in this, how it's positioning around the conflict in Iran, given, of course, it continues to face the aggression from Russia, particularly when it comes to drone defense. What role is Zelensky, what role is Ukraine playing?
I think it's really interesting, Tom, because, Zelensky is kind of the master of turning really terrible, very difficult situations into something of an opportunity. And we saw that, obviously, in the beginning of the Trump administration when you had that catastrophic meeting back in February in which, J.D. Vance was saying, have you even said thank you? Have you shown any sort of gratitude? So there was this idea that was being projected by the early Trump administration that the Ukrainians are just takers. What the Ukrainians are trying to do now and Zelensky is trying to do now is saying, no, we actually can be givers. We can be active partners in dealing with the drone defense. There's been a lot written about the huge amounts of money that has been spent to shoot down some of these very inexpensive drones with things like Patriot missile systems across the Middle East. And Zelensky has now deployed apparently 201 experts across the region after a number of Gulf nations have asked for the help to try to take down these drones because they can do it at much lower cost. They can make 2,000 anti-drone interceptors every single day. Half of those, they say, they're willing to export to partners. So that is something that the Ukrainians are really trying to sort of trumpet. You heard it from him in front of UK Parliament yesterday. He will go to Spain a little bit later today. But I also think it's an opportunity for him diplomatically to lend a hand to the Gulf nations who have been very ambivalent about Russia and its invasion of Ukraine, have been sort of hedging the sort of either side of it. And for the Ukrainians, this is an opportunity to say Iran equals Russia, Russia equals Iran, to try to keep them on board. Of course, now the big challenge will be keeping the Americans on board, and we really don't know how that is going to unfurl, particularly after the Europeans have stepped back from any involvement in Iran.
Oliver Crook, Bloomberg's chief Europe correspondent, with an update. Ollie, thank you. Let's get back to the markets and bring in Skylar Montgomery-Koenig from our Bloomberg M Live team. Skylar, look at the equity markets this morning. We're done. We've moved on from the Iran war. We're focused on other things. What's going on?
Yeah, I think it's a couple of things going on. The first is you definitely have had a positioning adjustment, but it's not been an outright reorientation of absolutely everything. So you'll see, for example, that the leverage community has moved very quickly to adjust to higher energy prices, but kind of slower moving real money isn't moving as quickly, and they're preferring to hedge in options rather than changing positionings outright. And so I think we're waiting to see whether or not energy prices stay elevated enough to really feed into that earnings downside because of growth coming down. And we're also just waiting for the central bank response, as in that could be a really big input into how the economy behaves. Yes, we know that higher energy prices are stagflationary. It's the worst kind of mix of lower growth and higher inflation. But do central banks take that on board and go, well, I think it's transitory, and so I'm not going to be as hawkish as the market's pricing. Maybe equities get a little bit of a boost in the short term, but then you have longer term inflation worries to consider.
So it's almost as if the markets have adjusted to the idea of a short-term war. a longer-term, more protracted conflict would perhaps provide something different and repositioning. Let's think about these central banks then. The Fed, of course, in focus today, Skylar. What are you going to be watching for critically? Or is anything Powell says just going to be discounted because he's not going to be in charge for that long? The future reaction function looks a bit opaque.
Yeah, I mean, there's two main things I'm watching for is how do they treat what we've already digested? As in, we've had 2 labor market reports this year. One was very strong, but then we got a very weak one. So are they interpreting that as a weak starting point? That means that maybe you won't get as much of an inflationary pressure. And then the second point is where are those dots going? So what are the expectations for how inflation feeds into those dots long term? And I will say this is one of those places I think there are more hawkish ranks than other central banks because the 2026 dot already has one cut. That's what the market's pricing. So it's the least out of line with market pricing from that perspective. And you could see that shift up more so, I think, than other places. And that's very in line as well with what I expect in relative markets in that U.S. fixed income has outperformed on this kind of yield upside, and so that means there's room for it to underperform as we go through these meetings.
Skylar, thank you. That's Skylar Montgomery-Koenig setting us up nicely for that Fed decision later. Skylar, of course, from Bloomberg's MLive team. Well, let's look ahead to what else we're watching throughout the day. Before we get that Fed decision, at 12:30 p.m. London time, we have US PPI numbers. Then at 1:45, we have a Bank of Canada rate decision. At 5 p.m, we have the Disney AGM, Josh D'Amaro becoming CEO, and then at 6 p.m. it's that Fed rate decision, followed by the press conference. And finally, at 9 p.m, we'll have Micron earnings as well.
Micron, you know, it's now a $500 billion company. So it crossed $500 billion by the end of the session yesterday. And this is a company that's exposed to the memory story. We know there's supply tightness and we know there's higher prices, between 30 to 40%, high bandwidth memory. Their chips are going to be embedded into Nvidia's platform, the Vera Rubin platform. So that is a really interesting story for us. As we see again today in the Korean session, massive gains again for Samsung and SK Hynix.
And it's really interesting, isn't it, on Micron to think about how much the business and also investors in the business are big fans of higher prices and pricing power. But how much do they want to sacrifice volume, or how much do they want to see Micron investing into that increased demand, which of course risk bringing down prices, but the environment just so hot right now. Maybe they just want both.
Yeah, and speaking of the volume thing and what you risk to keep your clients, Samsung weighing those multi-year deals to ease the memory chip crunch fears, but it's just so unusual to be committing for such long contracts, but it's clearly the market liking it, and as you say, that along with SK Hynix helping to push the cost be up 5% at the close today.
Jensen Huang says he has the licenses now to supply H200 chips into the Chinese market. That opens up a new revenue stream for Nvidia in the Chinese market. Right now, China's obsessed with OpenClaw. Jensen Huang also said that OpenClaw is the next ChatGPT moment. And OpenClaw and that story has powered Chinese AI companies
Finishing the programme with this conversation feels very much like things we did in February and January, doesn't it? And the cost be up 5% in session feels like that. Feels like that narrative is trying to work its way back onto our radar. I should just tell you that we will have a surveillance Fed special, of course, 5:30 p.m. London time. Remember, everything happening an hour earlier European time. The Pulse is next. This is Bloomberg.